Natasha.
Hi, sir. Sir, shall we start the session?
Yes, I can start.
Okay.
So can you should I be able to share the screen? Yes.
Yes. Uh,
Yes.
okay, students. Now, good afternoon, everyone. Welcome you all to Audit and Assurance Services lecture. So today's lecture will be conducted by our Vajra Lakdeva, sir. Sir, do you have the right sharing right, sir? I
Yes, I
made you
can
the
share.
co-host.
Yes.
Okay, sir.
Yeah, I can. I sent
Okay.
the materials yesterday. I don't know whether the materials have been uploaded to the portal.
Did you email me, sir? Oh,
I couldn't copy you. I sent it across to Dr. Ajwad. I'm sorry, I
Ah,
couldn't.
okay. Okay, sir. So if you can send me, I'll upload now, or else
Okay.
I can
Okay.
contact
Wait.
Ajwat sir and get it.
No. I will. Wait. Give
Okay,
me a
sir.
minute.
I'll upload it to LMS now.
Yeah. Okay. Today is 5:41. So anyway, that will be done after 2:50.
Okay, sir.
One moment.
So students, small
Your
note.
name goes as Natasha, no?
Yes,
N-A-T-A.
NATHA dot K. So shall I text
No,
you
Natasha.
the email?
Yeah, I should have no. Wait.
Yeah,
Natasha dot
Natasha at SJP dot like.
Wait, give me a minute. Just send it to you, right?
Okay, sir. I'll check.
Okay.
So students, before starting the lecture, small note, make sure you rename your name as CPM and the name to capture your attendance. Okay. Thank you, sir. Over to you.
Okay, thank you. Can you all see my screen? Can somebody confirm whether you all can see my screen?
Yes, sir.
Okay. Okay. Right. One moment. I will just ensure my mic. Right. Okay. Right. So good afternoon, everyone. Today we are going to discuss ISA 250 and 540 accounting estimate standard. So last time I couldn't do ISA 250. I only completed ISA 240. So the standard is consideration of laws and regulations in an audit of financial statement, right? So this is a hypothetical scenario effective from 15th July 2017. Not class standard responding to non-compliance with laws and regulation was introduced, which is a new ethics standard. So this is basically this scenario. Just we will read it out. So prior to NOCLA, which is before introduction of new ethics standard NOCLA, a hypothetical scenario. So after the standard, there were the ISA 250 standard was revised, right? So hypothetical scenario, assume that during an external audit, the audit manager discovers a serious environmental regulation breach supported by unequivocal evidence. The auditors take the issue to the client. So generally that is the process when there is an issue. So that is being discussed with the management who admits the infraction and subsequently makes a significant provisions and related disclosure in the financial statement to avoid material mistake. So what they have done was, so they have made a provision for any liabilities that may arise due to this environmental regulation breach, and then the relevant disclosures have been provided in the financial statement to avoid material misstatement. Now, if there are material misstatement, then you need to modify the audit opinion. So basically, your audit opinion should reflect those impact of those material misstatements. So the client has done, so made a provision and then provided related disclosures in the financial statement, but does not remediate the severe environmental consequences. So what they have done is basically they have got their books right. So making a provision and then providing disclosures. The issue is also raised with the board audit committee, which agrees to the financial statement action. So now what is the result is, while the environment impact remains inadequately addressed, so they have not done anything. The company financial statements are now free from material misstatement and unmodified opinion. So, we issue two types of opinion, unmodified and modified. Now, under modified, when you do auditor reporting standard, you will basically, learn the type of modified opinion and then the content of an unmodified opinion, which is the best opinion a client could receive from the client. Unmodified mean the auditor confirm that financial statement provide true and fair view of the results of operation and state of affairs as at the balance sheet date or statement of financial position date. Give me a minute, right? So unmodified opinion means the auditor issue an opinion confirming that the financial statement provide true and fair view of the results of operations and state of affairs as at the balance sheet date. Or in other words, the auditor confirmed that the financial statement have been prepared in all material respect in accordance with the applicable financial reporting framework, whether it is IFRS or Sri Lanka accounting standard or SME version. So this is a high level of assurance, but not an absolute level of assurance. Now, in this case, that is basically the unmodified opinion. But if there are misstatements, the auditor basically auditor modify the opinions. There are four types of modified opinion, right? The unmodified opinion is issued in the auditor's report. Neither the auditor nor management is required to take the issue further. So, but you will understand this is prior to the new ethics standard NOCLA. So, the environmental consequences or the severe environmental impact has not been addressed. Instead, a provision has been made in the financial statement along with the related disclosures. As a result, financial statements do not contain material misstatement and the auditor is ready to issue an unmodified opinion, right? Responding to non-compliance with laws and regulation or NOCLA. The International Ethics Standard Board for Accountants IESBA pronounced responding to non-compliance with laws and regulations NOCLA with effect from 15 July 2017, and Sri Lanka also adopted the NOCLA standard on the same day, which is 15 July 2017. Responding to non-compliance with laws and regulation in international ethics standard for auditors and other professional accountants. So basically, it doesn't cover only the auditors, but the other professional accountants in practice. Let's say now the professional accountants who are providing tax services, internal audit services, advisory services, and the professional accountants in business. Those who are working as finance directors, and then the CFO, finance manager, whoever, right? It sets out a framework to guide in what action to take in the public interest when they become aware of a potential illegal act known as NOCLA committed by a client or an employer or a vendor or senior management or those charged with governance likewise. So this actually it provides the process or the thought process to be followed by professional accountants when they come across a NOCLA. The standard includes a clear pathway to disclosure of NOCLA to appropriate public authorities in certain circumstances. The standard is the result of over 6 years of extensive consultation based on multi-stakeholder approach and stringent due process. Accordingly, as a set of ethical standard with global reach, the ESBA Code of Ethics for Professional Accountants plays a unique role in supporting the accounting profession in acting in the public interest. So you will see that this under the NOCLA standard, new ethics standard, it provides a clear pathway to follow when the professional accountants come across a potential illegal act known as non-compliance with laws and regulations, or NOCLA. The objective of NOCLA is to develop a framework to guide auditors and other professional accountants in public practice, so which I explained earlier, and professional accountants in business, PAIPs, in deciding how best to act in the public interest when they become aware of non-compliance or suspected non-compliance with laws and regulations. Now, why that this standard was introduced, right? The duty of confidentiality, one of the fundamental principles, the confidentiality under the code was acting as a barrier to timely disclosure by auditors of fraud and other NOCLA to regulatory and law enforcement authorities in the public interest. So, duty of confidentiality. What it says is a professional accountant should respect the confidentiality of information acquired as a result of professional and business relationship and should not disclose any such information to third parties without proper and specific authority, unless there is a legal or professional right or duty to disclose. And as an example, money laundering. So immediately you need to disclose it to the regulator if there is, risk of, money laundering by the entity or whoever within the entity. So confidential information acquired as a result of professional and business relationships should not be used for the personal advantage of the professional accountant or third parties, right? So the duty of confidentiality under the code was acting as a barrier, but that doesn't mean that under the due confidentiality before the NOCLA, the auditors were supposed not to disclose anything. That was not the case, but this will act as a kind of a barrier. So timely disclosure by auditors of fraud and other NOCLA to regulatory and law enforcement authorities in the public interest. So what happened was auditors simply resigning from the client relationship because of the identified or suspected NOCLA without the matter being appropriately addressed or without the matter being appropriately uh, taking it forward, right? A lack of guidance in the code about the thought process and relevant factors to take into account in determine appropriate course of action in responding to the matter in the public interest. So before the NOCLA, what happened was there was no clear pathway. What's the thought process to be followed? Before it is, that doesn't mean that under the NOCLA, whenever you see some illegal act, immediately go and you basically report to the regulator. It doesn't. It's not like that. But the standard provide clear pathway. What actions to be taken before a NOCLA is being reported to a regulator or law enforcement authority. So that is clearly provided, right? Accordingly, when the auditor discovered, prior to NOCLA, what happened? Accordingly, when the auditor discovered a significant non-compliance, he would communicate his finding to the management and those charged with governance. Those charged with governance being the board audit committee or the board of directors. However, depending on the nature of the non-compliance, auditor's response could stop at management management tackling the problem. Now, in the hypothetical scenario, so management agreed to make a provision and then to make the required disclosure in the financial statement. At that point, the auditor has stopped. But that is should not be the duty in the public interest of a professional accountant. The environmental, the breach of environmental regulations, they have not addressed, right? The management or the client has not addressed. Auditor or the public accountant should respect the confidentiality of information acquired as a result of professional and business relationship and should not disclose any such information to third parties without proper specific authority, unless there is a legal or professional right or duty to disclose. Right? So auditor or the public accountant should respect the confidentiality of information acquired as a result of professional and business relationship and should not disclose any such information to third parties without proper and specific authority unless there is a legal or professional right or duty to disclose. Being bound by the ethical duty of confidentiality, auditors have been criticized in the past for failure to report significant client breaches of laws and regulation. The code prior to NOCLA implicitly required PAs not to turn blind eye to potential NOCLA, but there was no explicit requirement on how to respond. So the previous code, before the NOCLA, it didn't have clear thought process to be or the clear pathway to be followed by the professional accountants. But under the new ethics standard NOCLA, it's explicitly given the thought process to be followed before a potential illegal act is being reported to a regulator. It did not have clear guidance, lack of thought process on how best to respond NOCLA in the public interest. But that doesn't mean it's very clear. That doesn't mean that the PAs to turn a blind eye when they come across a potential actual or suspected NOCLA. But only thing is, it did not have clear thought process to be followed when they come across a NOCLA. So these are the examples of laws and regulations covered: the bribery and corruptions, fraud, money laundering, terrorist financing, financial products and services and tax laws, the environmental protection, public health and safety. So as I explained earlier, it covers the auditors and other professional accountants in practice like internal auditors, tax professionals, and then the advice, those who are providing certain consultancy services, and then the professional accountants in business. So there are two categories: senior professional accountants in business and other professional accountants in business. So all four categories. Key elements and key intended outcomes of IESBA pronouncement responding to non-compliance with laws and regulation. What are the key intended outcomes? Ensuring that professional accountant respond in a timely way to identify those suspected NOCLA, because it provides clear pathway or the thought process to be followed by a professional accountants when they come across an illegal act or a actual or suspected NOCLA. Rectifying, remediating, or mitigating the adverse consequence of identified or suspected NOCLA to stakeholders and general public. Deterring the commission of NOCLA. When there is, clear thought process to be followed, it will deter the commission of NOCLA. Stimulating increased reporting of identified or suspected NOCLA where required by law or regulation or where determined appropriate under the code in the public interest. The new standard aims to raise the ethical bar for the global accountancy profession and to increase the emphasis on PA's duties and responsibilities. So this is basically NOCLA. So give me a minute. Can you all see my screen? Can somebody confirm whether you all can see my screen? Can you all see my screen?
Yes, sir, we can see.
Right. Just let me know whether you all can hear as well, right? I'm going to just play a video. Give me a minute, right? So that video doesn't work. I don't know why. I'm sorry that video doesn't work. So I will basically continue with the presentation. Whatever reason it doesn't work actually. I have to check that one. I will check and so this is basically that video doesn't work. Let me check that one, right? So ISA 250 revised with the introduction of NOCLA. So the standard deals with the auditor's responsibility to consider laws and regulation in an audit of financial statement. ISA 250 does not apply to other assurance engagement in which the auditor is specifically engaged to test and report separately on compliance with specific laws and regulation. As an example, in the case of bank audit, so you have got to report to central bank to confirm the compliance with the central bank guidelines and then the other, the compliance requirements. This ISA is effective for audit of financial statement for period beginning on or after 15 December 2017. So with the issue of NOCLA, the standard was revised. Now, effect of laws and regulations. Laws and regulation to which an entity is subject constitute the legal and regulatory framework. The organization, if you take an organization, there are general laws and regulations that are to be complied with. And there are specific laws. If you take a bank, there are specific laws to be complied with. Banking Act and the other, central bank guidelines and certain, compliance requirements. Then if you take an insurance company, then the insurance regulatory commissions and the guidelines and then whatever the compliance requirements in the IBSL Act, Insurance Board of Sri Lanka Act, are to be complied with. If you are a hospital, then there are specific compliance requirements. Then these are in addition to the general, laws and regulation. If you take any organization, they have to comply with the income tax laws. They need to ensure that they make provision for gratuity in line with the gratuity act, and then the payments are made for the eligible employees, which means those who have completed 5 years of service. So likewise, if you take the laws and regulation to which an entity is subject to constitute the legal and regulatory framework. Provisions of some laws or regulation. Now, there are two types of laws we consider, right? There are two types of laws. Provisions of laws and laws or regulation that have a direct effect on the financial statement, in that they determine the reported amounts, prescribes the applicable financial reporting framework and specific disclosures in an entity's financial statement. That is the first category. There are two types of laws. What is the first category? Provisions of some laws or regulation have a direct effect on the financial statement, in that they determine the reported amounts. In that case, this particular law or regulation act as the applicable financial reporting framework and discloses. Now, if you know, a financial reporting framework serves for four purposes: recognition, measurement, presentation, and disclosure. In this case, now the respective law or regulation act as the financial reporting framework. In that case, it determines, it guide the amount, the reported amount in the financial statements, and the specific disclosures that are to be made in the financial statement. Right? So, as an example, if you go to this, the first category is laws and regulation, generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. Now, if you take the income tax, now this is not the latest act, right? If you take the income tax, now the calculation of income tax is based on the uh, the the requirement of the tax law. Now, if you take, when you calculate the income tax, first you get the accounting profit or accounting loss, and then you added back certain expenses, and then you deduct certain expenses or income. As an example, depreciation is added back and capital allowances are allowed. So likewise, from the accounting profit or loss, you arrive at the taxable profit or loss, and then you apply the rate, whether it is 30%, or earlier we had 14% and 24%. Now it's 30% in most of the cases. So you apply the rate and make the amounts are recognized, whatever the current tax is recognized in the P&L under income tax, and then you recognize the liability. So in that case, the income tax law act as the financial reporting framework. The accounting standard never specify how the income tax to be calculated. Now, when it comes to deferred tax, so the relevant accounting standard is IAS 12, income taxes. So basically, you consider the tax base of the asset. Now, how do you calculate the tax base? It's based on the provisions of the income tax law. Then you compare the accounts base, the book base. Now, book base is, now as an example, net book value of property, plant, and equipment. Net book value of property, plant, and equipment, which is the book base, which is calculated as per the applicable financial reporting framework. Then you have the tax base, which is cost minus capital allowances claim. So that is basically tax base. And then you compare the book base with tax base and then apply the applicable tax rate. Tax rate is given in the income tax law. So in that case, both the accounting standard and then the tax law act as the financial reporting framework. Now, if you consider the pay tax, pay as you earn, or you call, a PIT. So how to calculate the tax, the tax, individual tax amount? Because in that case, the entity act as the agent on behalf of the Inland Revenue Department. Basically, the entity deduct the relevant tax and then remit it back to the Department of Inland Revenue. So how to calculate the payee tax is given in the income tax law. Then dividend tax, whether it is 10% or whatever. Deemed dividend tax, now of course that is not there. Remittance tax. Then you have social responsibility levy, which is 2.5% on revenue. So all that, now you will see that the laws and regulation generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. So that is the first category. There are two categories of law. The first category is laws and regulation generally recognized to have a direct effect on the determination of material amounts and disclosure in the financial statement. Now, if you take the gratuity, now there the Gratuity Act is number 12 of 1983. Under that, the employee is basically entitled for half a month's salary of the last drawn salary into number of years service at the time of resignation or retirement if they have completed minimum 5 years service. So the minimum service requirement is 5 years. So based on the accounting standard, after completing 1 year, we make the provision. So now basically you do actuarial valuation of gratuity. So the relevant law and regulation is Gratuity Act number 12 of 1983. Some companies make the provision based on half a month basis. Some companies basically actuarially value. Then value added tax, right? The nation building tax, that also again abolished. Then economic service charge, right? Then employees provident fund. So how much to be deducted for the employee, EPF and ETF. Now telecommunication levy act, right? Of number 21 of the telecommunication amendment, all these. Now if you say the telecommunication levy, that is deducted by the telco company. So all that now you basically charge and accounted for in the books of account based on the respective act. So this is the, I hope that you all are clear. This is basically the first category. What is the first category? Provisions of some laws or regulation have a direct effect on the financial statement in that they determine the reported amounts, prescribe the applicable financial reporting framework. In other words, this particular law or regulation act as a financial reporting framework. A financial reporting framework serves for four purposes: recognition, measurement, presentation, and disclosure. Now, certain laws provide specific disclosure requirement. Now the current Companies Act is number 7 of 2007. Before that, Companies Act was number 17 of 1982. Number 17 of 1982. Under that, there was a specific disclosure requirement related to loans granted to employees for a value of LKR 20,000. If the loan amounts granted to employees in excess of LKR 20,000, specific the movement of the loans to be given. That was a specific disclosure requirement that was required under the previous income, Companies Act. Now under the number 7 of 2007, Companies said there is no specific requirement. So certain from laws and regulation have a direct effect on the financial statement in that they determine the reported amounts. As I explained, income tax charge. Then when you calculate the deferred tax, gratuity, EPF, ETF, social responsibility levy, social security levy, then ESC, the economic service charges, VAT, all that act as a financial reporting framework in terms of recognition, measurement, presentation, and disclosures. Laws and regulation may also establish legal rights and obligation of the entity, which some will be recognized in the financial statement. Now, other categories, other laws or regulation are to be complied with by management or set of provisions under which the entity is allowed to conduct its business but do not have a direct effect on the entity financial statement. Now, as an example, what is the second category? Laws and regulation which do not have a direct effect on the determination of amounts and disclosure in the financial statement, but compliance with which may be fundamental to the operating aspect of the business. The compliance with such laws are fundamental to the operating aspect of the business. Now, what is the first category? Laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosure in the financial statement. In this case, these laws and regulations act as the financial reporting framework in that it serves one or all purposes of a financial reporting framework. What are the four purposes? Recognition, measurement, presentation, and disclosure. Now, this is the second category. Laws and regulations which do not have a direct effect on the determination of the amounts and disclosures in the financial statement, but compliance with which may be fundamental to the operating aspect of the business, which means if you don't comply with the laws and such laws and regulation, your it will be, your continue to maybe continuity may be at a risk. Now let's say now some, you have to pay rates to the local province, pradeshi sabha, so the urban councils, the non-compliance with which will not result in, sustainability issues to the organization. But this category is laws and regulation which do not have direct effect on the determination of the amounts and disclosures in the financial statement, but compliance with which may be fundamental to the operating aspect of the business. The first one is Telecommunication Regulatory Commission of Sri Lanka, TRC. Now it issues system licenses, frequency license, the vendor license, broadband, all that. If the particular telco company is not in compliance with the requirements set out in under these licenses, the licenses will be revoked. So now these licenses will not determine any amounts or disclosure in the financial statement, but compliance with the relevant compliance requirements attached to these respective license. If they don't comply, it will result in such continuity issues to the organization. So, which means the compliance with these laws and regulations are fundamental to the operating aspect of the business. Then Board of Investment of Sri Lanka. Now there are BOI companies, there are BOI zones. BOI companies, they are entitled for certain concessions. They are entitled for certain concessions. So sometimes tax exemptions, and they can import certain machineries and all that without import duty and all that. But there are compliance requirements also. There are compliance now. Why we give certain concessions to BOI companies, which are generally export oriented companies? So the expectation is they will produce the goods and and then even services, and they bring the foreign currencies to the country. So that is the expectation, right? Now, when there is now under this BO agreement, you can sell, a percentage in the local market. Generally, when you get an order, let's say 10,000 pieces, you don't produce 10,000, you produce 10,500. But then sometimes you can, whatever produce can be basically sent to the foreign buyer, or else you have to sell that 500, and there are certain B grade categories and all that you can sell in the local market. So that's why each and every BOI agreement there is a clause where you can go up to 10% and sell in the local market. Now, if they don't sell, if they sell more than that, that is a non-compliance. That is a non-compliance. If they don't comply with the relevant compliance requirements, let's say now they sell, they export. Give me a minute, right? Right? If they don't comply with, if they don't comply with the if they don't comply with the compliance requirements in the BOI agreements, then that will have, I mean, the compliance with such agreements is fundamental to the operating aspect of the continuity of the business. Then the Banking Act, another example, number 30 of 1988, initial capital requirements. If they don't have, meet the initial capital requirements, or in that case capital adequacy ratios, then it will be it will affect the continuity of the business. So the compliance with such laws and regulations are fundamental to the operating aspect of the organization. So likewise, insurance board also, there are solvency margin rules. And then, say as an example, the company shall maintain a capital adequacy ratio of a minimum of 120%. But every insurer shall maintain a total available capital of a minimum 500 million. So basically, there are two types of laws. The first category is laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. The second category, laws and regulation which do not have a direct effect on the determination of the amounts and disclosures in the financial statement, but compliance with which may be fundamental to the operating aspect of the business. So I actually explained some examples, so you will understand that the first category basically such laws and regulation act as the financial reporting framework, but the other laws and categories, the compliance with such laws are fundamental to the operating aspect of the business. Now you will see there, there was an insurance company, general insurer, Selinco Takafu. So that is basically operated under Sharia law. So their license was revoked. So they actually did not, they were unable to comply with the compliance requirements. And very large insurance company, there, about 10 years ago, their license was suspended for 1 week, and thereafter it was granted again. Certain finance companies license have been they have been central bank has basically suspended operating. So likewise, so if they don't comply with these the laws and regulation which are fundamental to the operating aspect of the business, so that will affect their continuity. These are the two types of laws and regulation we consider when it comes to this particular standard, right? Other laws or regulation are to be complied with by management or set of provisions under which the entity is allowed to conduct its business. So if you don't have the relevant license, a telco company will not be able to operate. An insurance company or a bank or a financial institution or a hospital will, they will not be able to operate, but do not have a direct effect on an entity financial statement. So I hope you are clear with the two types of laws. First one is the laws and regulations that have a direct effect on the financial statement, in that they determine the reported amounts and discloses in an entity's financial statement. So other laws and regulations are to be complied with by management, or the or set the provisions under which the entity is allowed to conduct its business, but do not have a direct effect on an entity's financial state. Non-compliance with laws and regulation may result in fines, litigation, or other consequences for the entity, and that may have material effect on the financial statement. Now, if you don't comply with the income tax law, the income tax department, they will issue an assessment. They will issue an assessment. If an insurance company is not compliant with the insurance, board requirements, or regulatory commission guidelines, or the insurance act requirements, IBSL Act requirement, then they will either suspend, or they will fine, or the result in fines, litigation, or other consequences. Now, the responsibility of the management over laws and regulations. The primary responsibility lies with the management. It is the responsibility of management, with the oversight of those charged with governance, which means board, audit committee, to ensure that the entity operations are conducted in accordance with the provisions of laws and regulations, including compliance with provisions of laws and regulations, that determine the reported amounts and disclosure in a financial statement. So what is the responsibility to ensure that the entity's operations are conducted in accordance with the provisions of laws and regulation, including compliance with. So first one is the second category, laws and regulation. This second category, laws and regulation which do not have a direct effect on the determination of the amounts and disclosure in the financial statement, but compliance with such laws may be fundamental to the operating aspect of the business, including compliance, second category, compliance with the provisions of laws and regulation that determine the reported amounts and disclosure in an entity's financial statements. That's the first category. Laws and regulation generally recognized to have a direct effect on the determination of the material amount. So as I explained, if you take the laws and regulation, there are general laws and regulations that are to be complied with by any organization, and there are specific laws applicable to different organizations based on the industry. For a hospital, for an insurer, a bank or financial institution, telco company, or an export-oriented company, which has entered into an agreement with the Board of Investment. So likewise. So the responsibility of the auditor basically is a secondary responsibility. Who has the primary responsibility? It's the management with the oversight of those charged with governance. In accordance with ISA 200, which probably would have done up to now, overall objective of the independent auditor and the conduct of an audit in accordance with Sri Lanka auditing standard. The auditor is responsible for obtaining reasonable assurance, which is a high level of assurance, but not an absolute level of assurance, that the financial statement as taken as a whole are free from material misstatement, not are free from misstatement, are free from material misstatement. Probably would have done the material standards, so you would have discussed already overall materiality, performance material, right? Whether caused by fraud or error. In the context of laws and regulation, the auditor should identify the material misstatements of financial statement due to non-compliance with laws and regulation. What are the two types of law? Non-compliance with laws and regulation generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement, and non-compliance with laws and regulations which do not have a direct effect on the determination of the amounts and disclosures in the financial statement, compliance with which may be fundamental to the operating aspect of the business or the continuity of the organization operations, right? Audit is subject to an unavoidable risk due to inherent limitation that some material misstatement of the financial statement will not be detected, even though the audit is properly planned and performed in accordance with auditing standard. The auditor is not responsible for preventing non-compliance with laws and regulation and cannot be expected to detect all non-compliance with the laws and regulations. So that is already there, because we do an audit based on the samples, and then and we never express an opinion. The auditor never express an opinion. The financial statements are true, accurate, or correct. We provide the opinion stating whether the financial statements provide true and fair view, or whether the financial statement have been prepared in all material respect. In all material respect, in accordance with the applicable financial reporting framework. So in that case, so which provide a reasonable assurance, but it is a high level of assurance, but not an absolute level of assurance. In that case, the auditor is not responsible for preventing non-compliance with laws and regulations, and cannot be expected to detect non-compliance with all laws and regulations, right? So you'll understand the primary responsibility lies with management, with the oversight of those charged with governance, whereas the auditor also has a responsibility. In that case, it's a secondary responsibility. The auditor's responsibilities are distinguished in relation to compliance with two different categories of laws and regulations. That's what I explained. The provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement, such as tax and pension laws, income tax, gratuity, right? Other laws and regulations that do not have a direct effect on the determination of the amounts and disclosures in the financial statement, but non-compliance with which may be fundamental to the operating aspect of the business, to an entity's ability to continue its business or to avoid material penalties. So as an example, compliance with the license issued by the Insurance Regulatory Commission. As I explained, the Selinco Takaful Limited. Now you know Amana Takaful, again that is an insurance company which operates under Sharia law. So Selinco also started some about 15 years ago, but their license was revoked and to date it has not been reissued due to various issues with the Selinco group. Now one of the very largest, one of the very large insurance company, very prominent insurance company, license was suspended for 1 week, about I would say 10-12 years ago, which was reissued again. And they were allowed to operate as an insurer. So there are situations finance companies have been suspended by the central bank. So likewise, right? Now, such as compliance with terms and of operating license issued for telecommunication companies by the Telecommunication Regulatory Commission. Compliance with regulatory solvency and other requirements set out in IBSL Act number 43 of 2000 and other guidelines circulars issued by it should be issued to insurance companies by insurance regulatory commissions. Then compliance with safety and health and environment regulation. Now, if you take for a manufacturing company, the impact of these will be very high. If you take a hospital, then there are specific compliance requirements. So the non-compliance with such laws and regulation may therefore have a material effect on the financial state. So I hope you are clear with the two types of laws. I have given some examples as well. So are there any questions on those two types of laws? Is everyone clear on that before I move forward? If there are any questions, so when I am actually doing the presentation, I cannot see the chat messages. If there are any questions, you can either ask or send a chat message so that I can answer. So it's very important that you be very clear with the two types of laws which we discuss with the examples, right? So I will give 30 seconds. If there are questions, please ask. If not, please send a chat message. Right. So let me continue. So reporting on compliance with specific requirement of laws and regulation in the auditor's report. In accordance with specific statutory requirements, the auditor may be specifically required to report as part of the audit of financial statement. Basically, when the auditor issues the audit opinion on whether the entity complies with certain provisions of laws and regulation. As part of the audit report itself, the auditor is required to comment on those laws and regulation, compliance with the certain provisions of the laws and regulation. Furthermore, where there is a specific statutory report in requirement, it may be necessary for the audit plan to include appropriate tests for compliance with those provisions of laws and regulation. Now, there are, as part of the, if you take a bank audit, you issue the audit opinion on the statutory financial statement, and then there are specific reporting requirements on the internal controls or the corporate governance or any other compliance requirements as per these central bank guidelines or circulars. So there are other specific reporting requirements. Now, example is the report on other legal and regulatory requirements companies set. These financial statement also, if you take any audit report, this will be there. These financial statement also comply with the requirement of section 151 2 and section 153 to 153.7 of the Companies Act. So again, when it comes to a insurance company audit report, the accounting record of the company have also been maintained by the management in a manner required by the rules made by the Insurance Regulatory Commission of Sri Lanka, established under the Regulation of Insurance Industry Act number 43 of 2000, so as to clearly indicate the true and fair view of the financial position of the insurer. Now you see these are specific reporting that are to be made in the auditor's report. In addition to that, there are other compliance reporting requirement by the auditor. In the telco companies, the compliance with the different licenses issued, the frequency, broadband, all these licenses, the different compliance requirements are there. So the compliance with those are basically reported to the Telecommunication Regulatory Commission by the auditor of the respective telco company, right? Now, as part of this standard, the objective of the auditor are to obtain sufficient appropriate audit evidence. Now, sufficient report to the quantity, and then appropriateness refer to the reliability and relevance. Sufficient appropriate audit evidence regarding compliance with the provision of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosure in the financial statements. What is that is the first category. Laws and regulation generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. Obtain sufficient appropriate audit evidence regarding the compliance with the provisions of those laws and regulations. As an example, income tax law, VAT law, EPF, ETF, social security levy, right? NBT or payee or whatever, right? Generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. To perform specified audit procedures to help identify instance of non-compliance with other laws and regulations that may have a material effect on the financial statement in the event of a non-compliance. In the event of a non-compliance. So that is the second category. Laws and regulations which do not have a direct effect on the determination of the material amounts and disclosures in the financial statement, but compliance with which may be fundamental to the operating aspect of the business. In other words, non-compliance with such laws will have a significant effect on the continuity of operations of the entity. As an example, insurance company is now not complying with the requirement of the IBS the guidelines or circulars issued by the Insurance Board of Sri Lanka, right? To respond appropriately to identify those suspected non-compliance with laws and regulations identified during the year. So there you will identify non-compliance under two categories. So there will be, let's say, as an example, the income tax provision, current tax provision in the financial statement not in line with the applicable income tax law. Either there is under provision or an over provision. So that is a compliance, non-compliance, right? But you consider the materiality. You have already completed, you have done the material standard. So always when it comes to audit, materiality play a critical role, right? So I hope you are clear with the overall materiality and performance material, right? To respond appropriately to identify those suspected non-compliance with laws and regulation identified during the audit. First category and second category, right? Now, if there is non-compliance with the licenses issued by the Telecommunication Regulatory Commission, The auditor may even consider qualifying the financial statement on the ground, ground of that. So there will be a significant issue with the going concern of the entity. So next week we will do the going concern standard, right? Now, what is a non-compliance? Acts of omission or commission, intentional or unintentional. Now, intentional mean fraud. Unintentional is an error. There is no intention, but it's due to an error. It may be due to negligence or lack of knowledge or whatever. But intentional is uh, so there is intention to commit a fraud. So non-compliance, as an example, so let's say the BOI companies, they can import raw, machinery and all that. Sometimes the raw materials also without the duty or import levy, duty. Now expectation is for them to produce the ultimate, the end product here and then to export it and then to bring foreign currencies to the country. So that's the whole thing. That's why they up until recent times, until the rate was increased to 30%. So these export oriented companies were enjoying a concessionary tax rate. One time it was 12% and then it was 15 and then 14 or something. Now it is actually 30%. Now let's say a company which import under the tax concessions, import raw material, if they sell those in the local market without producing the end product and exporting it to the buyers, then what would happen? It's a intentional misstatement or non-compliance. It's a fraud actually. So that's why it says act of omission or commission, intentional or unintentional, committed by the entity or by those charged with governance, by management or by other individuals working for or under the direction of the entity, which are contrary to the prevailing laws and regulation. Such acts include transactions entered into by or in the name of the entity or on its behalf by those charged with governance, management, or employees. Could be intentional or unintentional. Include personal misconduct related to business activities of the business by those uh, charged with governance, management, or employees of the entity, but does not include misconduct unrelated to business. Now, the non-compliances could be intentional or unintentional, include personal misconduct related to business. If it is unrelated, then it will not have an impact on the organization. Whether an act constitute an non-compliance is a legal determination and may be beyond the auditor's professional competence. So the auditor will not act as the auditor will not perform the court of law proceedings. Basically, we will identify and then we will consider the impact to the audit opinion, and then under the NOCLA, if it is if the entity has not taken the required action, then the auditor will consider reporting to the appropriate regulatory authority or law enforcement authority. So that is basically, but auditor will not determine whether basically the legal determinations, right? Requirements to be complied with by the auditors. The auditor's consideration of compliance with laws and regulation as part of understanding an entity and its environment in accordance with ISA 315 revise, so basically identifying and assessing the risk of material misstatement. The auditor shall obtain a general understanding of the legal and regulatory framework applicable to the entity and in the industry or sector in which the entity operates. Basically, as part of understanding, now under this ISA 315, we understand the entity and its environment, including in its internal controls. Entity and its environment, including internal controls, right? Now, these are the things: the entity and its environment, the internal control. There are 5 components, right? Control environment, entities risk assessment process, the information system, including the related business process relevant to financial reporting and communication, control activities and monitoring of control. Under the understanding, the purpose of, so what is this? Basically identifying and assessing the risk of material misstatement through understanding the entity and its environment. As part of understanding the entity and its environment, the auditor is required to understand and evaluate relevant industry, regulatory and other external factors, including applicable financial reporting framework. And these things also, there are 5 areas to be considered. So as part of obtaining an understanding of the entity and its environment, including internal controls, the auditor shall obtain a general understanding of the legal and regulatory framework applicable to the entity and the industry or sector in which the entity operates. As I explained earlier, there are general laws and regulations that are applicable to all organizations, and there are specific laws and regulation applicable to different industries based on the industry or the sector in which such entities operate. Second one is how the entities comply with that framework or the laws and regulations. So I explained that if you see, the primary responsibility to comply with the laws and regulations lies with the management with the oversight of those charged with governance. So the responsibility of the auditor is actually auditor has a secondary responsibility. So the auditor is responsible for obtaining reasonable assurance that the financial statement taken as a whole are free from material misstatement, whether caused by fraud or error. In the context of laws and regulation, the auditor should identify the material misstatement of financial statement due to non-compliance with laws and regulations. And there are 2 types of laws, right? So for the auditor to obtain that reasonable assurance, the first thing is auditor has to understand the legal and regulatory framework applicable to the entity and the industry or the sector in which the particular entity operates, and how the entity is complying with that framework or the laws and regulation. As part of internal controls of the organization, there should be internal controls. First, there should be internal controls to identify the laws and general laws and regulations that are applicable and specific laws and regulations that are applicable to the organization, and then to come up with a plan, the how to comply with such laws and regulation and internal controls to ensure that the entity complies with the laws and regulation. Any non-compliances are detected through the internal control. So that's basically the primary responsibility of the management with the oversight of those charged with governance. And the auditor is required to understand. Without the understanding the applicable laws and regulation, auditor will not be able to perform the testing in order to obtain sufficient appropriate audit evidence. To obtain sufficient appropriate audit evidence regarding compliance with the provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement, and then to perform specific audit procedures to help the auditor to identify instances of non-compliance with other laws and regulations that may have a material effect on the financial statement, right? Auditor's consideration of compliance with laws and regulations. The auditor should obtain sufficient appropriate audit evidence. So that is what I will explain. The first category. The auditor, then second category, the auditor should perform the following audit procedures to help identify instances of non-compliance with laws and regulation that may have a material effect on the financial statement. So these are the procedures. The auditor's consideration of compliance with laws and regulation. Inquiring of management and where appropriate those charged with governance. Now, generally the board audit committee as to whether the entity is in compliance with such laws and regulations that are applicable to the organization. So you make an inquiry. Inspecting correspondence, if any, with the relevant licensing or regulatory authorities to understand whether there are any non-compliances being reported by the respective regulatory authority or law enforcement authority. So when you make inquiries from management, you will speak to the finance, you will speak to the legal officer, you will get, basically you will speak and you will get written representation from the external lawyers who are acting on behalf of the organization, and then you will speak to different personnel within the organization without limiting your inquiries only to the CFO or the finance function, right? That is very important. Certain other laws and regulation may need particular attention by the auditor because they have a fundamental effect of the operations of the entity. So that is the second category. Non-compliance with laws and regulations that have a fundamental effect on the operation of the entity may cause the entity to cease operations or call into questions the entity's continuance as a going concern. Right? So certain, now I explained several times, the insurance non-compliance with the licenses issued by the Insurance Regulatory Commission, Telecommunication Regulatory Commission, or the bank, central bank. So likewise, right? Requirements to be complied with by the auditor. Maintaining professional skepticism. Remain alert to the possibility that other audit procedures apply may bring instances of non-compliance or suspected non-compliance with laws and regulation. Now, maintaining professional skepticism basically that doesn't mean that you approach an audit with foregone conclusion that there are non-compliance or fraud. That is not the expectation. But you critically evaluate audit evidence and to consider whether there are misstatements. So when you do the other work also, you have to corroborate. You have to maintain professional skepticism to identify actual or suspected non-compliance. When you read in the minutes of the board of directors or the board audit committee or management, so generally they would discuss those non-compliance at the meetings. When you read the meeting, if there are something like that, then you have to relate your testing towards those, right? Inquiring of the entity's management and in-house legal counsel or external legal counsel concerning litigation claims and assessment. So you would go through the legal and professional fees to identify to whom the legal and professional fees have been paid. Now let's say if they have paid to a tax consultant, we will understand for what purpose. Then you will understand that the Department of Inland Revenue has issued an assessment. There is a potential non-compliance with the Inland Revenue Act. Performing substantive test of details of classes of transaction, account balances or disclosure. Example, reviewing the professional and legal expenses. So that is basically maintaining professional skepticism. Obtaining written representations. Considering the fact that laws and regulation can very considerably request management and where appropriate, those charged with governance to provide written representation that all known instances of non-compliance or suspected non-compliance with laws and regulation, whose effect should be considered when preparing financial statement, have been disclosed to the auditor. This is the written representation itself will not provide sufficient appropriate audit evidence, but it will provide additional audit evidence. But auditor has to ensure he or she obtains the required understanding of the legal and regulatory framework applicable to the organization in terms of general laws and regulation and specific laws, and then understand the internal controls the entity has put in place to comply with the applicable laws and regulation, and how they identify the non-compliance with laws and regulations, right? Then basically when performing other maintaining professional skepticism, which means when performing other tests like audit procedures like reading minutes, and then inquiring of management and in-house legal counsel or external legal counsel, and performing substantive testing on when we perform substantive testing on specific areas to identify any indication of non-compliance with laws and regulations, right? Indicators of non-compliance with laws and regulations, right? Investigation by state institutions. If there is an investigation by state institution, by the Custom Department or Inland Revenue Department, likewise. Payment for unspecified services without identifying the services. Transaction not at arm's length. Now you know the transaction with related parties or related undertakings, as per the transfer pricing laws which have been enacted in Sri Lanka, the transaction should be at arm's length. Transaction should be at arm's length. If the transactions are not at arm's length, which may indicate that you are not in compliance with the laws and regulations. Unusual payments, payments without proper source documents, adverse media comments, transfer of funds to tax havens, right? These are the indicators. If you see these indicators, that there could be actual or suspected non-compliance with the laws and regulations. Audit procedures when non-compliance is identified or suspected. Auditors should. Now, generally, these are the audit procedures when non-compliance is identified or suspected. Auditor should obtain an understanding of the nature of the act and the circumstances in which it has occurred. First is very important to understand. Further information to evaluate the possible effect on the financial statement. Matters relevant to the auditor's evaluation of possible effect on the financial statement, including evaluation of potential financial consequence, including fines, penalties, damages, expropriation of assets, enforced discontinuation, and litigation. As an example, if the entity has not, they have deducted the EPF and ETF but has not remitted to the regulator, then what would happen? Under that, if you have not remitted, and there are penalties, right? So auditor has to understand the potential financial consequences. Whether potential financial consequence requires special disclosures in the financial statement, depending on the materiality and the severity of the potential financial consequences. Whether fair presentation or true and fair view is in question in respect of due to non-compliance with the laws and regulations. So when there are when the non-compliance is identified or suspect, the first thing is auditor should obtain an understanding of the nature of that and the circumstances in which it has occurred. And then auditor should obtain further information to evaluate the possible effect on the financial statement, the potential financial consequences, whether potential financial consequences require special disclosures in the financial statement, whether fair presentation, true and fair view is in question. Auditor should then discuss the finding with management and those charged with governance unless prohibited by law and regulation. As an example, if there is the terrorist, the non-compliance like, money laundering or terrorist financing, you are required to immediately report to the regulator without discussing it internally. There is imminent breach, right? Then obtain legal advice, in-house legal counsel or external legal counsel. If management may extend to auditors on legal counsel also, if management or those charged with governance do not provide sufficient information when possibility of fraud and effect on non-compliance on financial statement considered material. Assess the implication on other aspect of audit, including auditor risk assessment and reliability of written representations, right? When the entity does not take remedial action, consider appropriate in the circumstances, even when the non-compliance is not material to the finances, the auditor may withdraw from the management, inform incoming auditor if the client has given permission. If not, inform incoming auditor that the client has denied the discussion of its affairs. If withdrawal from the engagement is not possible, the auditor may consider alternative action, including describing the non-compliance in another matter paragraph in the auditor's report, in accordance with ISO 706, which is emphasis of matter paragraph and other matter paragraph in the independent auditor's report. So generally, if the auditor considers withdrawal, but under the NOCLA, you cannot withdraw. You have to take it forward under NOCLA. The auditor may consider basically reporting to appropriate regulatory authority if the auditor, the management actions do not provide the required comfort, and then the non-compliance is considered to be severe, right? So the emphasis of meta paragraph and other meta paragraph, I'm not going to discuss the why is actually when you do the auditor reporting standard, you will understand. And then when you refer after doing the auditor's report standard, when you refer these things, you will understand what is an emphasis on meta paragraph and what is an other meta paragraph, right? So the communicating and responding identified or suspected non-compliance. Communicating identified or suspected non-compliance to those charged with governance. Communicate matters with those charged with governance unless prohibited by law involving identified or suspected non-compliance that come to the auditor's attention during the course of the audit, other than when the matters are clearly inconsequential. If in the auditor's judgment non-compliance believed to be intentional, communicate as soon as possible. That is actually a fraud. If the auditor suspects that management or those charged with governance are involved in non-compliance, communicate matter to the next higher level of authority at the entity chairman of the board or audit committee. If no such an authority exists, auditor is unsure whether communication may be acted upon, then consider obtaining legal advice. So this again the potential implication of identified or suspected non-compliance for the auditor's report. If the auditor, so I am not going to discuss these things. As I explained, there are two types of provisions, unmodified and modified. Now modified basically, unmodified, unmodified is basically the auditor expresses an opinion that financial statement provide a true and fair view, or financial statement have been prepared in all material respect in accordance with the applicable financial reporting framework. So that is the best opinion a client could receive from the auditor, unmodified. We call it unqualified or clean report. Then there are modified opinion. There are four types of modified opinions arising from two things. Due to a limitation of scope, which means auditor has been unable to perform audit procedures in order to obtain sufficient appropriate audit evidence. Scope limitation means auditor has been unable to perform required audit procedures auditor has determined in order to obtain sufficient appropriate audit evidence. Then the other one is departure from financial reporting framework, or financial statements are materially misstated. I'm just explaining at very high level. When you do the auditor reporting, you will understand. What I do here is just to relate this to this particular standard ISA 250, right? Now, unmodified opinion, you all know, which is unqualified or clean opinion, which is the best opinion. Basically, financial statement provide true and fair view. All financial statements have been prepared in all material respect in accordance with the applicable financial reporting framework. So you will move away from unmodified and issue a modified opinion under two circumstances. You will move away from an unmodified opinion and issue a modified opinion under two circumstances. There are four types of modified opinion. Qualified opinion due to a scope limitation, qualified opinion due to departure from financial reporting framework, then disclaimer of opinion and adverse opinion. The two circumstances is scope limitation. Auditor has been unable to perform the audit procedures in order to obtain sufficient appropriate audit evidence due to a scope limitation, basically client impose or condition impose. Then auditor has performed required audit procedures. Auditor has performed required audit procedures and has obtained sufficient appropriate audit evidence and conclude that financial statement as a whole are not free from material mistake. What is the second one? Auditor has performed sufficient appropriate auditor has performed audit procedures and has obtained sufficient appropriate audit evidence and conclude that financial statement as a whole are not free from material misstatement. In other word, financial statements are materially misstated. In other word, financial statements are materially misstated. When you say financial statement as a whole are not free from material misstatement, in other words, it is financial statements are materially misstated. So these are the two circumstances under which auditor issue a modified opinion. A modified. Now you will understand modified opinion is not a good one. No client will like to have a modified opinion. They always like to have unmodified opinion. Now when it comes to modified opinion, if you take the scope limitation, the auditor, I explained that when it comes to auditing, materiality play a critical role. Now, any account set will have misstatement. If you take those who work in audit firm, they know that when you do an audit, there are misstatements. So that is not a new thing. It is a normal thing. When you do an audit, there are misstatements. But auditor has to consider whether the misstatements are material or immaterial. That is how we assess based on the materiality levels we calculated. What are the materiality levels we calculated? Under 320 standard, performance materiality, overall material. So once, if there are these two comes, one is the scope limitations, other one is departure from financial reporting framework, or financial statements are materially misstated. If it is material but not pervasive, auditor issue qualified opinion. This is actually we call except for opinion, which means except for this one, the rest is okay. Qualified opinion means that. So auditor provide the basis for qualified opinion, that is called except for opinion. Except for this, the rest is okay. Rest provide true and fair view or have been prepared in all material respect in accordance with the applicable financial reporting frame. So that is basically at high level qualified opinion, material but not pervasive. Pervasive mean it's so material, it affects many line items in the financial statement and the impact considered to be both material and pervasive. Sometimes you will not understand very clearly on these concepts, but when you do ISA 700, 705 and 706, you will understand. The first one is if the impact is considered to be material but not pervasive, we issue qualified opinion that is considered to be except for opinion. So unmodified, then modified, there are four categories. The first one is under scope limitation, we issue a qualified opinion. Under departure from applicable financial reporting framework, or in other words, financial statements are materially misstated, we issue qualified opinion, provided possible effect or effect considered to be material but not pervasive. Considered to be material but not pervasive. If it is both material and pervasive, in the case of scope limitation, auditor issue a disclaimer of opinion. Disclaimer of opinion mean auditor is not issuing an opinion. In the auditor's report, auditor explain due to significance of the matters disclosed, we do not express an opinion. That is called disclaimer of opinion. Auditor is not issuing an opinion. Then adverse opinion. Financial statements are materially misstated, the effect is considered to be both material and pervasive. In that case, adverse. Now, adverse is the right opposite of unmodified opinion. Adverse is the right opposite of unmodified opinion. Now, what is unmodified opinion? In our opinion, financial statement provide true and fair view of the results of operation and state of affairs as at 31st December 2022. Or, in our opinion, financial statements have been prepared in all material respect in accordance with Sri Lanka accounting standards. That is the unmodified opinion. Now, what is adverse opinion? In our opinion, financial statements do not provide true and fair view. Or in other words, in our opinion, financial statements have not been prepared in all material respect in accordance with Sri Lanka accounting standards. So you will see that adverse opinion is right opposite of unmodified opinion, which is issued when the financial statements are materially misstated. Auditor concludes that the impact is both material and pervasive. In the case of scope limitation, if the possible impact is considered to be both material and pervasive, auditor issue a disclaimer of opinion, which is auditor is not expressing an opinion. That is disclaimer of opinion. The qualified opinions are issued when the effect of scope limitation, when the possible effect of scope limitation and effect of departure from financial reporting framework considered to be material but not pervasive. I hope you have got a high level understanding, but when you do the auditor reporting standard, you will discuss certain, the examples related to scope limitation and then departure from financial reporting framework. So that's with that. Now you will see that if the auditor conclude that the identified or suspected non-compliance has a material effect on the financial statement and has not been adequately reflected in the financial statement, the auditor shall issue in accordance with ISA 705 express a qualified or adverse opinion. So this is basically if the auditor conclude that the identified or suspected non-compliance has a material effect on the financial statement, which means financial statements are materially misstated. Depending on whether if the now this is this side, right? Qualified or adverse mean if the effect is both, if effect is material but not pervasive, qualified opinion. If the effect is both material and pervasive, adverse opinion. That's what it says. If the auditor conclude that the identified or suspected non-compliance has a material effect on the financial statement and has not been adequately reflected in the financial statement, the auditor shall, in accordance with ISA 705, revise, express a qualified or an adverse opinion on the financial statement. Then second one is if the auditor is precluded by the management or those charged with governance from obtaining sufficient appropriate audit evidence, which means what? Scope limitants, client infos. So that's what it says. Audit evidence to evaluate whether the non-compliance that may be material to the financial statement has or is likely to have occurred, the auditor shall express qualified or disclaim an opinion on the financial statement on the basis of scope limitation of the audit in accordance with ISA 705. If there is a scope limitation, which means the auditor has not been able to perform the required audit procedures to understand the impact of the non-compliance, actual or suspected. And if auditor considered the possible effect is material but not pervasive, then qualified opinion. But if auditor conclude that the possible effect is both material and pervasive, disclaimer of opinion. So that's what it says. Now you will understand under one, we consider financial statements are materially misstated, which means under this financial statements are material misstatement due to non-compliance. So qualified opinion when impact is material but not pervasive. Adverse opinion, impact is material. Adverse opinion, impact is both material and pervasive. Scope limitation, right? Scope limitation. Auditor has been unable to perform required audit procedures in order to obtain sufficient appropriate audit evidence. In that case, if the possible effect is material but not pervasive, qualified opinion. If possible effect is both material and pervasive, disclaimer of opinion, which means auditor is not expressing an opinion. When you do the auditor reporting standard, you will see the standard wording. The unmodified opinion, I hope you can remember. Then qualified opinion, which is except for. That means except for that, the rest is okay. Disclaimer is you are not expressing an opinion. Adverse means right opposite of unmodified. It's so material. Financial statements are so materially misstated. Unmodified opinion is basically adverse mean the right opposite of unmodified. Unmodified, as I explained, provide true and fair view. Hope we have been prepared in all material respect in accordance with the applicable financial reporting framework. Adverse opinion wordings are financial statements do not provide true and fair view, or financial statements have not been prepared in all material respect in accordance with the applicable financial reporting framework. So what I suggest is when you do the auditor reporting standard, or even today I have at high level explained the type of modified opinion and then how those modified opinion relate to non-compliance with laws and regulations, and then the type of opinion to be issued, qualified or an adverse opinion, qualified or a disclaimer of opinion. So I just explain at high level. Please refer to these few slides after the lecture when you have a time. But when you do the auditor reporting standard at detail level, ISA 700, 705, you will understand these slides, better when you complete those sessions, right? So this is same thing I explained. Reporting identified those suspected non-compliance to appropriate authority outside the firm. So as I explained with the NOCLA, it provides the clear pathway, but that doesn't mean that whenever you identify the non-compliance, you go and immediately report to a regulator unless otherwise the non-compliance relate to terrorist financing or money laundering or something, as per the laws require immediate reporting to the regulator. The auditor should determine whether the law, regulation, or relevant ethical require the auditor to report to an appropriate authority to outside the entity. Establish responsibilities under which reporting to an appropriate authority outside the entity may be appropriate in the circumstances. Now, these are the some of the practice questions. Explain the auditor's responsibilities in relation to detection of entities non-compliance with laws and regulation in an audit of financial statement. If you refer to the slide, you can find out. In accordance with ISA 250, consideration of laws and regulation in an audit of finances, the auditor is required to obtain sufficient appropriate audit evidence and entity compliance with laws and regulations. List 4 factors that may indicate an entity's non-compliance with laws and regulations. List 4 factors that may indicate an entity's non-compliance with laws and regulations. These are the indicators of non-compliance. If you write 4 of these, you will get the full mark of 4 to 5 marks, right? International Ethics Standard for Board for Accountants, IESBA, pronounced new ethics standard responding to non-compliance with laws and regulation, NOCLA, with effect from 15 July 2000. Briefly explain why the standard was introduced and the key intended outcome the standard expect to achieve. Now, if you go to first slide, objective, why the standard was introduced, right? All these things are there. So I mean, what are the key intended outcomes? So this sort of a question will carry about 5 to 6 marks, right? So you need to be very, very clear with the two types of laws. Two types of laws. You need to be able to explain the two types of laws that are to be considered under the standard. So you should be able to explain these two laws with the examples. You don't want to write all these examples, but one or two just to show that you understand the concept, that would suffice the need, right? With an example. So I have given examples. So this is what I have to discuss under this particular standard. Before I go to the other standard, ISA 540, are there any questions which you need to clarify before I move to accounting estimate? I will try my level best to complete it as much as possible. If not, it will be anyway. We will have, in addition to the next week lecture, there will be a additional lecture if there is something left over, right? So, are there any questions that require clarification before I start with the ISA 540 revise? So, if there are, please ask or send a chat message. I will give you 1 or 2 minutes, right? Okay, it appears that there are no questions. So let me start with 540 standard. Right. So the standard was basically revised in 2019. So this standard is auditing, accounting, estimate, and related disclosures. So this is a very important standard. So you need to basically be familiar with this particular standard. Uh, So ISA 540 revised deals with the auditor's responsibilities related to accounting estimate and related disclosures in an audit of financial statement. So we will be discussing what are accounting estimates, right? Specifically, it expand on how other relevant ISAs are to be applied in relation to accounting estimate. It also includes requirements and guidance on misstatement of individual accounting estimate and indicators of possible management bias. As we go along, we will discuss these concepts. Now, this is basically the project timeline, and the new standard ISA 540 revised was effective for period beginning on or after 15 December 2019, which means the standard was effective for financial period commence on or after 1st January 2020, right? Because it was effective for periods beginning on or after December 15, 2019. Early adoption was permitted and encouraged, right? Now the standard is in force, right? Now some financial statement items cannot be measured precisely. So some financial statement items cannot be measured precisely, but can only be estimated, right? Such financial statement items which require to be estimated are referred to as accounting estimate. If you take in today's business environment, we see many uncertainties and complexities in the business models. And we see, if you take today's context, we see the business model which were not there if you take 10 or 15 years back. On top of that, if you take last 15 to 20 years, we have seemingly moved away from cost model to fair value model. Now, when you take fair value model, now when you take accounting estimate, you have accounting estimate and fair value accounting estimate. Last 10 or 15 years, if you take, we mostly the cost model was used, and we had some standard where the fair value or the, if you take PP, the cost model and the revaluation model was allowed. If you take investment property, cost model and fair value model was allowed. But if you take last 15 to 20 years, we have seemingly moved away from the cost model to fair value model. Now, fair value cannot be observed with market data in all the cases. If you take an investment which is classified as fair value through PNL or OCI, if it is listed in the Colombo Stock Exchange, so you can easily do the fair valuation by reference to market data. But if it is a listed, non-listed entity, then you have to estimate. So that's why it says some financial statement items cannot be measured precisely but can only be estimated. Such financial statements are referred to as accounting estimate, which include fair value accounting estimate. Right? Accounting estimate vary widely in nature and are required to be made by management when the monetary amounts cannot be directly observed. Let's say if you go and buy a plant or machinery or some asset, you have the invoice and you can easily account for that in the books of account. So there is no issue. Let's say you sell electronic items, let's say Abans or Singer or Softlogic or Damro, then they provide additional warranty over and above the manufacturer's warranty. So these are the to increase the revenue. So basically, they are in the consumer durable industry. Now, when you give warranty, additional warranty, that will not be covered through manufacturer's original warranty, but they go beyond the manufacturer's warranty period and then offer basically to as a sales promotional technique. Some people charge a fee, some people they don't charge a fee. So when you give warranty, let's say even when you sell a laptop, when you sell a AC or something like that, you give a warranty. Then you need to make a provision for warranty in the books of account. But that cannot be measured precisely. You don't know what's going to be the actual expenditure. When it comes to accounting estimate, you try to look into the future based on the best available information as of now. When it comes to accounting estimate, you look into the future based on the best available information as of now. So that is accounting estimate. So when it comes to, as an example, warranty provision, you need to consider historical pattern of claims which has resulted during the warranty period, and then any improvements you have done to your production and manufacturing process if it is on produce, or else the client if it is purchased from the third parties, and then to see what are the likelihood of and magnitude of a claim arising, and then to make a provision. If you take a bank, now you need to make the provisions under the expected loss model. You need to make provision for expected loss model. So you need to consider all other, you have to have a method or a model, and then you have to use data, and you have to use certain assumptions to arrive at the provision for loans, customer loans or advances granted. So we call it loan loss provision, right? The measurement of those monetary amount is subject to estimation uncertainty. Why? Estimation uncertainty is there because you have to, it cannot be measured precisely, but can only be estimated. When you estimate, there is always estimation uncertainty. For certain accounting estimate, the estimation uncertainties would be very high. For certain accounting estimate, it could be considered as low. which reflect inherent limitation in knowledge or data. So as I explained, when it comes to accounting estimate, you look into the future based on the best available information and try to come up with the monetary value for the particular accounting estimate or fair value accounting estimate. These limitations give rise to inherent subjectivity and variation in the measurement outcomes. The process of making an accounting estimate involves selecting and applying a method or model. We call it MAD. Method, assumptions and data, method or model. Now, if you take share-based payment, equity settled share-based payment or cash settled share-based payment, generally acceptable model that is being used by organization is Black-Scholes model. Black-Scholes model. If you take the annual report of Sri Lanka companies who have offered a share option scheme, generally they use Black-Scholes model. If it is when it comes to actuarial valuation of defined benefit obligation, projected unit credit method. But when it comes to value in use calculation, you have to use an entity specific model. When you assess the impairment of goodwill arising on a business combination, when you determine the warranty provision to be made, when you consider the loan loss provision to be made, when you consider the impairment, inventory provision to be made. So you have to use, entity specific model. So that's what it said. The process of making accounting estimate involves selecting and applying a method or a model using assumptions. Now, when it comes to value in use, the revenue growth rate, expense, and all these things, assumptions and data. Data you have to use, which require judgment by management and can give rise to complexity in measurement. So estimation, uncertainty, complexity. The effect of complexity, subjectivity, or other inherent risk factors on the measurement of these monetary amounts affect their susceptibility to mistake. They are mean the accounting estimate susceptibility to mistake. The nature, timing, and extent of risk assessment and further audit procedures required will vary in relation to estimation uncertainty. So you need to clearly understand not all accounting estimate will carry higher inherent risk. Not all accounting estimate will have higher estimation uncertainty. Sorry. Right? The nature, timing, and extent of the risk assessment and further audit procedures required will vary in relation to the estimation uncertainty and the assessment of the related risk of material misstatement for accounting estimate differently, because the degree to which an accounting estimate is subject to estimation uncertainty substantially will vary substantially from one to another. If you take now the useful life of property, plant, and equipment, that is an accounting estimate. But if you consider, you can easily refer. Now, if you take generally the building is 40 to 50 years, motor vehicles 5 years, but there are motor vehicles even generally last 20 years, 25 years even. But the generally acceptable useful life for motor vehicles is 5 years. Computer is 3 years. Then if you take plant and machinery, generally 8 to 10 years, right? So likewise. But if it goes, let's say now you can easily observe with the available data, the other entities. I can remember one hotel in the down south. They use their buildings. The useful life has 200 years. 200 years. Their argument was, this is a hotel building. We regularly maintain this. It is in the very good condition at any given time, so that 200 years of useful life is justified. But generally, the useful life is acceptable is 40 to 50 years. So it was basically qualified. So this particular company, a qualified opinion was issued, and this was a listed entity. It was issued about 20 years ago, right? And then they changed subsequently the useful life. So when it comes to, if you take The useful life of B, property, plant, and equipment, generally the estimation uncertainty of that accounting estimate is basically considered to be low. If you take impairment of inventory, the provision for inventories, if based on the industry generally acceptable model, if it's a apparel sector, generally over 90 days they make provision. If you take footwear, generally over 120 days, because that is the industry norm. Likewise, if you take the tire, after 3 years about 100%, 2 to 3 years about 50%. There are industry norms. So generally, the estimation uncertainty is for these accounting estimate considered to be low. So that's what we need to understand. Not all accounting estimate will carry a higher inherent risk or higher level of estimation uncertainty. That is very vital for you to understand, right? When estimation, uncertainty, complexity, and subjectivity, these are inherent risk factors. Estimation, uncertainty, complexity, and subjectivity, as we go along, we will discuss, are very high. Such procedures would be expected to be so much more extensive, and vice versa. So this is called scalability. Now, I explain, not all accounting estimate will carry higher level of estimation uncertainty or inherent risk. Some accounting estimate the inherent risk considered to be low. Some accounting estimate inherent risk considered to be not low, which means high. So if the estimation, uncertainty, complexity, or subjectivity, which altogether we call inherent risk factors, are very high, such procedures would be expected to be much more extensive, and vice versa. Which means vice versa mean when estimation, uncertainty, complexity, and subjectivity are considered to be low, such procedures. Now, what such procedures? The risk assessment and further audit procedures would be expected to be much more extensive, and vice versa. If you consider value in use calculation, which is an accounting estimate, or fair value of investment in a non-listed company, you will consider estimation uncertainty, complexity, and subjectivity are very high. And there are other inherent risk factors like management bias, and then the risk assessment procedures and further audit procedures, which mean nature, timing, and extent of audit procedures to be more extensive. And if it is other way around, then it will be less extensive. So that is called scalability, right? It is required a separate assessment of inherent risk. Now, under the audit risk model, if you take risk of material misstatement, you consider two things: inherent risk and control risk. I believe you have already covered the audit risk model. So you have the audit risk, you have detection risk, and the risk of material misstatement. Under risk of material misstatement, you have inherent risk and control risk. What is the inherent risk? It's the susceptibility of an assertion to a misstatement that could be material either individually or in aggregate with other misstatement, assuming that there are no control. So under this particular standard 540, it is required a separate assessment of inherent risk of accounting estimate. So you have to assess the control risk separately and inherent risk separately. For the purposes of assessing the risk of material misstatement at the assertion level for accounting estimate. So what you do when it comes to accounting estimate? Identify and assessing the risk of material misstatement attached to each accounting estimate, including fair value accounting estimate, and responding to assess risk of material misstatement. When you assess the risk of material misstatement, you generally consider the inherent risk and control risk together. But under this particular standard, it is required a separate assessment of inherent risk. Separate assessment of inherent risk, considering the inherent risk factors and other inherent risk factors. What are the inherent risk factors? Estimation uncertainty, complexity or subjectivity, to assess whether the inherent risk is high or low. So that is because not each and every accounting estimate carry a higher level of inherent risk, right? Inherent risk is higher for some assertions and related classes of accounts and transactions, account balances, and disclosures. Accordingly, the assessment of inherent risk depends on the degree to which the inherent risk factors. What are the inherent risk factors? Estimation, uncertainty, complexity, and subjectivity affect the likelihood or magnitude of misstatement. Likelihood or magnitude. This is the likelihood of misstatement occurring. Magnitude of misstatement is basically if a misstatement occur, what is the magnitude of potential mistake? Now, if you take and varies on a scale that is referred to as spectrum of inherent risk. Now, this is spectrum of inherent risk. Now, if you take this axis, basically likelihood for a material misstatement to occur. This is called spectrum of inherent risk. A likelihood of material misstatement occur, which means likelihood of misstatement occurring, magnitude of potential mistake. Now, if you take now something here, I think you can see my cursor. Now, likelihood is low, magnitude of potential misstatement is low. In that case, inherent risk is low. Something that is here, a likelihood for a potential, a likelihood for a material misstatement is also very high. Magnitude of potential misstatement is very low. Now, this some star somewhere here would be considered as high level of inherent risk. Now, here likelihood of misstatement occurring is low, but in case misstatement occur, magnitude is very high. Here, likelihood is very high, but if a misstatement occur, the magnitude is very low. So, based on where the different, the risk related to different accounting estimate get plotted in this spectrum of inherent risk, which is based on two dimensions: likelihood for a misstatement to occur, magnitude of potential misstatement. Auditor will consider the inherent risk. Why? Under this standard, it is required a separate assessment of inherent risk. What is the inherent risk? Which is the susceptibility of an assertion to an misstatement that could be material, either individually or when aggregated with other misstatement, assuming that there are no control. So if you see here, something here, the inherent risk is low. So based on the auditor's judgment, considering the spectrum of inherent risk, considering the likelihood and magnitude, auditor has to assess the inherent risk attached to each accounting estimate, including fair value accounting estimate. Depending on that, if that is called scalability, based on the spectrum of inherent risk, if the inherent risk considered to be lower, then less extensive risk assessment procedures and further audit procedures. If it is very high, now as an example, the depreciation, which is an accounting estimate, provision for inventories, which is an accounting estimate. So probably these will get plotted in the lower end of the spectrum of inherent risk, which means less extensive risk assessment procedures and further audit procedures, which mean nature, timing, and extent of audit procedures. If it is higher, as an example, value in use calculation, fair value estimation of privately held investment, the goodwill impairment assessment for a goodwill arising on a business combination, right? Loan loss provision or something like that. More extensive risk assessment and further audit procedures. So I hope up to now you are clear. This is spectrum of inherent risk where the accounting estimate the risk get based on the inherent risk factors affect the likelihood or magnitude of misstatement based on where the different risk get plotted in the spectrum of inherent risk. You will determine the level of the risk assessment procedures and further audit procedures, which is basically the standard provides scalability depending on the inherent risk. Now, inherent risk factors are estimation uncertainty, complexity, and subjectivity, right? Auditor is required to evaluate based on the audit procedures performed and the audit evidence obtained, whether the accounting estimate and related disclosures are reasonable in line with the requirement of the applicable financial reporting framework. So that is the expectation of the auditors, including recognition, measurement, presentation, and disclosure requirement, which inter alia include the making of accounting estimate, including the selection. I explained the process of making an accounting estimate involves three things: method or model, assumptions, and data. That called MAT, right? In view of the nature of accounting estimate and the facts and circumstances of the entity. The selection of management point estimate, which is the amount that is appearing in the books of account. As an example, loan loss provision, the provision is 150 million. That is management point estimate. If you consider the provision for warranty claims, 45 million, that is select management point estimate, right? The display, if you take the investment property fair value, if they follow the when under the LKS 40, you can follow the cost model as well as fair value model. If it is fair value model, at each reporting date, fair value has to be estimated. So, and then under the LKS 40, there are the different disclosure requirements. So, it is generally done by a independent valuer who will say, okay, let's say now Liberty Plaza, the value is 2.5 billion. And there are certain disclosure requirements, sensitivity analysis, the basis of valuation, whether it's income approach, cost approach, or market approach. So all that need to be disclosed. So that's why it says how the accounting has been, accounting estimate has been, or the fair value accounting has, fair value accounting estimate has been made. What is the method or model use, assumption use, and the data use, and the selection of management point estimate, and the disclosures about the accounting estimate, including disclosures about how the accounting estimate was developed, and that explain the nature, extent, and sources of estimation uncertainty, right? The auditor shall review the outcome of previous accounting estimate. So let's say last year there was a provision for warranty which is 45 million. The auditor has to see how it has moved, what was the actual outcome. So that is required when it comes to accounting estimate. The reason being, when it comes to accounting estimate, you look into the future based on what is available as of now. And depending on the management motive, there could be possibility for management bias. If they want to set the provision at high level, let's say they have a profitability target of 500 million, now they have gone past that and they have 620 million. So there could be a management motive or bias. Let's increase the provision for debtors impairment, and that can be released next year when we have lower profit. That's why it says the auditor shall review the outcome of previous accounting estimate, or where applicable, their subsequent re-estimation to assist in identifying and assessing the risk of material misstatement in the current period. A difference, however, we should understand that a difference between the outcome of an accounting estimate and the amount originally recognized or disclosed in the financial statement does not necessarily represent a misstatement of the financial statement on the basis that previously accounting estimates were made based on the information available at that time. So if you consider the last year provision was 50, but the actual has become 65, that doesn't necessarily mean a misstatement, because when it comes to accounting estimate, you look into the future based on the best available information that is available when you make that estimate that amount. So certain, event that occurred subsequently could change the amount. So that is why very important. But we also need to understand whether this difference has occurred due to a management bias. So that is very important. So why it says accounting estimates share one characteristic above all others. What is that? They are looking to the future, and consequently could be subject to higher or lower degree of estimation uncertainty and other inherent risk factors making them. Depending on the method, assumptions and data use based on the best available information at which date the estimate is made. They could be subject to higher or lower level of estimation uncertainty and then other inherent risk factors, resulting in either high or low inherent risk, right? So that is basically an overall view for accounting estimate, just to set the context. I hope you are clear with the process of accounting estimate, right? When it comes to this particular standard, the auditor's objective, the objective of the auditor is to obtain sufficient appropriate auditor evidence similar to any other standard, to obtain sufficient appropriate audit evidence. If you are unable to obtain sufficient appropriate audit evidence, that is a scope limitation, which we discussed towards latter part of the previous presentation, right? What is that? Scope limitation. It could be due to situational specific or management in force or due to change in the nature or timing of the audit work. As an example, if management is not giving the information, sometimes organization they don't share their recipes for certain products. Now, if you ask, if you take KFC, they don't share the recipe of the batter they use. That is their competitive advantage. Otherwise, they also use the normal chicken. But what makes KFC different from other people is they are better. So they don't share. But there should be some way to share. So if there is, scope limitation either due to management enforce, situational enforce mean, let's say accounting records have been destroyed due to a fire or flood, or accounting record have been seized by a government, regulator, customs. Sri Lankan customs has seized all accounting records. That is again beyond the management or control of the management, but that is a scope limitation, right? So the objective of the auditor is to obtain sufficient appropriate audit evidence about whether the accounting estimate and related disclosures in the financial statements are reasonable in the context of the applicable financial reporting framework. Right? Definitions. Accounting estimate. A monetary amount for which the measurement, in accordance with the requirement of the applicable financial reporting framework, is subject to estimation answer. Or, in other words, by certain financial statement line item that cannot be measured precisely but can only be estimated are considered to be accounting estimate, right? Auditor's point estimate or auditor's range. So we discuss management point estimate, that is the amount which is appearing in the financial state. But when it comes to auditor, he or she could calculate auditor's point estimate. Auditor would say, now these are accounting estimate. So much of judgments and management assumption involved, right? You cannot just refer to an invoice or market data to get. Auditor also could end up with point estimate. Auditor would say, based on the management point estimate, warranty provision is 110 million. Based on the past record and future expectation, the provision should be 125 million. So there is an under provision of 15 million. So auditor's point estimate. Management point estimate was 110 million. Auditor's point estimate is 125 million. So there is an under provision of 15 million. So since it's very judgmental, auditor also would calculate the auditor's range. Let's say the management point estimate is 110 million. Auditor would say it should be in the range of 125 to 140. It should be in the range of 125 to 140. That is the range. The auditor has not calculated a point estimate. If let's say the first scenario, so I hope you are clear, auditor's range is, it should be in the range of 125 million to 140 million range. As long as management point estimate is within that range, there is no mistake. In the first scenario, management point estimate is 110 million. In that case, you will consider the lower end of the range, which is 125 million. So there is a mistake. Assume that management point estimate was 130 million, which is within the range. What was the auditor's range? 125 million to 145 million. So now the management point estimate is 130 million, which is in the range of within the range of the auditor's range. What is the auditor's range? 125 million to 140. Then there is no mistake. If it was 110 million, which is outside the range of auditor's range, which was 125 to 140, there is, if you consider lower end, there is a misstatement of 15 million again. So auditors point estimate to auditors range. The amount or range of amount respectively derived from audit evidence. So derived from audit evidence. So first you decide the audit procedures and then perform those audit procedures to obtain sufficient appropriate audit evidence based on the derived from the audit evidence for use in evaluating the management point estimate. So either auditor will determine a point estimate or a range that will be compared with the management point estimate, because management has to come up with a point, because you cannot give a range in the financial statement, right? Then estimation uncertainty, the susceptibility to an inherent lack of precision in its measurement. So we will give the detailed definition as we go along. The estimation uncertainty, subjectivity and complexity, basically altogether under the new standard we call inherent risk factors. Management bias, a lack of neutrality by management in the preparation of information. So when it comes to accounting estimate, it requires management judgment, assumptions, using different assumptions, data, and using a model or method. So depending on the management motive, there could be management bias. There could be lack of neutrality. The financial reporting framework call for neutrality. Then management point estimate, the amount selected by management for recognition or disclosure in the financial statement as an accounting estimate. Warranty provision, or likely outcome of a pending litigation which is disclosed under pending litigations. Outcome of an accounting estimate after the fact. The actual monetary amount which result from the resolution of the underlying transaction. As an example, there was a provision for bonus, and then subsequent to the year end, it has been paid. So the bonus provision was 100 million, and subsequently they have paid 130 million. Again, there is a misstatement by 30 million. That doesn't mean that it is material. This 30 million could be material or immaterial depending on the materiality level decided for the audit based on the overall and performance materiality level, right? The key enhancement under the standard, inherent risk factors. What are the three things? Estimation, uncertainty, complexity, and subjective. What are the inherent risk factors? Inherent risk factors are characteristics of conditions and events that may affect the susceptibility of an assertion to a misstatement before consideration of control. Basically, it refers to the inherent. Inherent risk arise from the inherent risk factors. There are three inherent risk factors as per the standard: estimation, uncertainty, complexity, subjectivity. There may be other inherent risk factors that the auditor is required to take into account. Change. Basically, there could be change to the financial reporting framework or circumstances. Susceptibility to misstatement due to management bias or fraud. So those are other inherent risk factors, right? So if you go back to our initial discussion, so basically you consider the inherent risk factors, estimation, uncertainty, complexity, and subjectivity, which are called together called inherent risk factors, and then consider the uh, based on the likelihood or magnitude of misstatement, and which is we call spectrum of inherent risk to determine the whether the inherent risk is high or low. If it is inherent risk is low, then less extensive risk assessment procedures and further audit procedures. If it is considered to be high, more extensive risk assessment and further audit procedures, right? Now, complexity. Let's start with the estimation uncertainty. Is the susceptibility to an inherent lack of precision in the measurement of an accounting estimate. Precision, right? Estimation uncertainty influences the other inherent risk factors. The degree of estimation uncertainty varies based on the nature of accounting estimate. A certain accounting estimation uncertainty considered to be very high. The extent to which there is a generally acceptable method or model used to make the accounting estimate. As an example, share-based payment, black schoolers model. Then uh, actuarial valuation of defined benefit obligation. Three areas are required to be considered: discount rate, long-term increment rate, and the staff attrition. Now, when it comes to black schoolers model law, you have to consider the exercise date and then the exercise price, grant date, all these other things. So I will discuss. So I have put a slide on that, right? The degree of estimation uncertainty varies based on the nature of accounting estimate. The extent to which there is a generally accepted method or model used to make the accounting estimate. Now, if you take value in use, there are no generally accepted model. You use DCF, calculations, but it is very much in, entity specific. Warranty calculation, I mean, you cannot use the model used by Damrof or Singer. And if you consider the loan loss provision, what is the model and assumption data that is used for commercial bank cannot be used for BOC. The circumstances are different, right? And the subjectivity of the assumptions, different assumptions. Now, when we discuss, the share-based payment, whether there is a certain assumption, there is no subjectivity. But certain assumption there could be subject. If you consider the value in use, the growth rate, how the cost, the increases, discount rate, in particular in the current environment, determining discount rate is, it's very, very, subjective, because now the treasury bill and treasury bond rate have significantly gone up. So you cannot use that as it is. So you have to come up with a model to eliminate the whatever the country risk and all the default risk for you to arrive at the most appropriate discount rate. All that creates subjectivity to use to make the accounting estimate. Then complexity is the complexity inherent in the process of making accounting estimate. So as I explained earlier, the process of making an accounting estimate involve using a method or a model, using assumptions and data. And there could be complexity in the complexity inherent in the process of making an accounting estimate, such as when multiple data sets or assumptions are required or when complex models are used. So complexity is very high. Now, if you determine the useful life of property, plant, and equipment, the complexity is not there. And if you determine, the process for making provision for slow and unmoving inventories, I mean, very kind of straightforward. The inherent risk factors will not result in higher level of inherent risk. Subjectivity arises when inherent limitation in the knowledge or data reasonably available about valuation attribute, right? Management bias. Financial reporting framework often call for neutrality. That is freedom from bias. Accounting estimates are imprecise. Why? They cannot be measured precisely but can only be estimated. However, can be influenced by management judgment or different motives. So I explained earlier also, depending on their targets, they could basically consider certain adjustment to the accounting estimate, which of course we have seen when we do the audit. It's not a new thing, right? So generally these are there in the organizations. Because most of the, so when I did, fraud standard, I explained, most of the senior management, a significant part of the remunerations are linked with the achievement of objectives. And year on year revenue growth and profitability are key performance indicators or key targets. Naturally, there could be management bias, but that, the management bias could result in a higher level of inherent risk when it comes to accounting estimate, because accounting estimate cannot be measured precisely but can only be estimated, right? Such judgment may involve unintentional or intentional management bias. For example, as a result of motivation to achieve a desired result, the susceptibility of an accounting estimate to management bias increases with the subjectivity involved in making it. Unintentional management bias and potential for intentional management bias are inherent in subjective decisions that are often required in making an accounting estimate. For continuing audit, indicators of possible management bias identified during the audit of preceding period influence the planning and risk identification and risk assessment activities of the auditor in the current period, right? Now, if you take the overall estimation uncertainty uh, related to accounting estimate and fair value accounting estimate. As I explained, accounting estimate and fair value accounting estimate share one characteristic above all others. That is, they are an attempt to look into the future and are consequently could be subject to higher or lower degree of estimation uncertainty and inherent risk of mistake due to inherent risk factors, which are estimation uncertainty, subjectivity, and complexity. And then the other inherent risk factors like management bias are to be considered. As I explained, not all accounting estimate would result in higher level of estimation uncertainty, resulting in higher inherent risk. High degree of estimation uncertainty susceptibility for management bias, intentional or unintentional. That one category. Low degree of estimation uncertainty and susceptibility for management bias, intentional or lower level of, in this case, higher level of inherent risk of misstatement, right? Considering the magnitude of potential misstatement and likelihood of misstatement occurring, then lower level of inherent misstatement. Now, if you see, when you consider the inherent risk and estimation uncertainty, you consider the nature of accounting estimate, reliability of the information used, whether generally accepted model is available or not, subjectivity of the assumption used to make the estimate, assumptions and data used to make the estimate, possibility for management judgment and assumption or management bias. So basically, in essence, it considered the method or the model, assumptions and data. Now, lower level of misstatement, useful life of PP, estimated of quoted price of shares. But if you consider the estimation of fair value of an unlisted entity, where it would result in a higher level of inherent misstatement, depending on the magnitude of potential misstatement and likelihood of misstatement occurring. Then higher level, estimate of an outcome of a litigation. If there is a litigation, if you are to estimate the outcome of the litigation, that definitely requires entity specific model, then assumptions and data. Then impairment of goodwill arising from a business combination, estimating warranty claims, value in use calculation for a property, plant and equipment or non-current assets. So these result in, so that's why you need to understand if there is exam question, all accounting estimate carry a higher level of inherent risk. Do you agree with this statement? Discuss with examples. In that case, if you say, yes, all accounting estimate carry a higher level of inherent risk, you will not get even a single mark. So as I explained several times, not all accounting estimate would result in a higher level of estimation uncertainty and higher level of inherent risk. Some accounting estimates are straightforward and which result in lower level of inherent risk. Some examples are useful life of PP, estimate of quoted price of share, estimate of inventory obsolete. However, in the case of these examples, if you consider the inherent risk factors, estimation, uncertainty, subjectivity, and the complexity, they would consider as uh, high, and then would eventually result in a higher level of inherent risk of misstatement, right? So estimation uncertainty. Estimate with low estimation uncertainty. So I mean frequently made and updated because they relate to routine transaction, depreciation in inventory, obsolescence, derived from data that is readily available, quoted price of shares. Fair value accounting estimate, where the model used to measure the accounting estimate is well known. As an example, share-based payment, Black Schoolers model. Fair value accounting estimate, where the method of measurement prescribed by the applicable financial reporting framework is simple and applied easily to assets or liability requiring measurement at fair value. As an example, projected unit credit method when it comes to actuarial valuation of defined benefit obligation. Estimate with high estimation uncertainty. Outcome of litigation. Derivative financial instrument not publicly traded, which require, so you need to go with the valuation techniques. It may be level 1, level 2, level 3, right? Fair value accounting estimate for which highly specialized entity developed model is or method is used, right? So examples of situation where the fair value accounting estimates are required. Complex financial instrument which are not traded in an active or open market. Share-based payment, property, plant, and equipment held for disposal, so which are to be fair value. Certain assets and or liabilities acquired in a business combination, including goodwill and intangible assets. So under SLFRS 3, you need to fair value assets and liabilities, including contingent consideration acquired in a business combination, including the fair value of the purchase consideration. Transaction involving the exchange of assets or liabilities between independent parties without monetary consideration. For example, a non-monetary exchange of plant facilities in different lines of business. So these will require high level of, fair value accounting estimate. Now this is the risk-based approach. So we follow risk-based audit approach. So under risk-based audit approach, we identify the risk of material misstatement, and then we develop audit procedures which are responsive to identified risk of material misstatement in order to obtain sufficient appropriate audit evidence. Sufficiency refers to the quantity, where the appropriateness refers to the relevant and reliability, right? So there are four things basically: risk assessment procedures and related activities. Same thing we did under 250. Responses to the assessed risk of material misstatement. Further substantive procedures when it comes to significant risk. So I would have explained under the S240. So some of the risk of material misstatement we identify will constitute a significant risk based on the nature of the risk, magnitude of potential misstatement, and likelihood of misstatement occurring. Right? This is similar to the spectrum of inherent risk. Under ISA 315, you would have discussed identifying and assessing the risk of material misstatement. We identify risk of material misstatement at financial statement level, at assertion level for classes of transaction, account balances, and disclosures. You would have already discussed, so I'm not going to go into detail, but just to set the context. So some of the risk of material misstatement you identified at the financial statement level or at assertion level constitute a significant risk, or auditor will consider as significant risk. Considering the nature of the risk, whether there is a risk of fraud. Under ISA 240, I said if there is a risk of fraud, that is straight cut is a significant risk, right? Likewise, whether it is related to a complex transaction, whether is a transaction is a non-recurring one, whether the transaction or is with the related party. So that is the nature of the risk. Then magnitude of potential misstatement and the likelihood of occurring. Some of the risk of material misstatement are considered as significant risk. The standards specify the thought process to be followed in order to determine whether any of the risk of material misstatement identified at financial statement level and at assertion level constitute a significant risk. So you will see here risk assessment procedures and related activities. What is the purpose? To identify the risk of material misstatement associated with accounting estimate. Then respond into assess risk of material misstatement. So I explained some of the accounting estimate, the inherent risk could be low. Some accounting estimate could be high. So depending on our follow of the basically that process, you will identify some of the accounting estimates as significant risk. Then what procedures are to be followed. Then evaluate the reasonableness of the accounting estimate in the context of the applicable financial reporting framework. Right? So under the risk assessment procedures and related activities, understanding the entity and its environment, including internal control related to accounting estimate, degree of estimation uncertainty and inherent risk factors associated with each accounting estimate identified by the auditor. Because if you take a set of financial statement, there are many accounting estimates. Now, if you take balance sheet, PPE, depreciation is an accounting estimate. If there is an impairment, that is an accounting estimate. If you take right of use asset, determination of lease liability is an accounting estimate. Then intangible assets, amortization is an accounting estimate. If you take financial assets, sometimes the fair value accounting estimate, fair values require estimation. If you take inventory, NRV, and provision for obsolescence. And then if you take debtors, provision for impairment, all that are accounting estimate. So you need to understand the entity and its environment, including internal controls related to accounting estimate, to identify the inherent risk factors attached to each accounting estimate, and then to determine the level of estimation uncertainty and the inherent risk associated with each accounting estimate. Then degree of accounting estimation uncertainty and inherent risk factors, and then to determine which accounting estimate could result in significant risk. As an example, I would say if there is uh, fair valuation of investment property, then goodwill impairment generally we consider as significant risk. But you need to go through that thought process. Nature, magnitude of potential misstatement and likelihood of misstatement occurring. Then responses to assess risk of material misstatement. When making the accounting estimate, I explained you have to have the method or model, then you use assumptions and then data. Whether the requirement of applicable financial reporting framework is applied when making the accounting estimate. Methods are appropriate and applied consistently. As an example, when you calculate the investment property, if your purpose is to earn rental income, then generally you are supposed to use the income approach for the purpose of fair valuation. You cannot change it unless otherwise the circumstances have changed. Changes are appropriate. Then test subsequent events you have to consider, test management estimate and develop points. So I will explain as we go along. Then it comes to significant risk estimation uncertainty, alternative assumption, significant assumption, management intent to carry out specific action and ability, develop a range or evaluate management estimate. Develop a point estimate or a range to evaluate management estimate, recognition and measurement criteria. Then the fourth one is evaluate the reasonableness of accounting estimate in the context of applicable financial reporting framework. Basically, reasonableness, adequacy of disclosures, indicators of management bias and written representation. Risk-based approach to accounting estimate. ISA 540 expand on how ISA 315, which is the risk assessment standard, ISA 330 is the responding to assets risk, and others are to be applied to accounting estimate. Obtaining an understanding of the entity and its environment through risk assessment procedure, which I explained under laws and regulation also. I don't want to go into that detail, right? Based on that understanding, identifying and assessing the risk of material misstatement. Obtaining sufficient appropriate audit evidence regarding the assessed risk through designing and implementing appropriate responses to those risks. The first one is risk assessment procedures and related activities. Now there are 4 risk assessment procedures. Understanding of the requirement of applicable financial reporting framework. If it is share-based payment, so you need to know SLFRS 2 requirements, right? Including the recognition, measurement, and presentation and disclosure requirements relevant to the accounting estimate, including related disclosures that are to be made in relation to that particular accounting estimate or fair value accounting estimate in the financial statement. How regulatory factors affect or relevant to the accounting estimate. As an example, when you make the provision for loan loss, how do you consider the guideline issued under the central bank, right? Likewise, understanding of how management identify the need for accounting estimate to be recognized and disclosed. So, what is the process within under the internal controls to identify the different accounting estimate, the need for accounting estimate to be recognized or disclosed? What sort of internal controls are put in place by the management with the oversight of those charged with governance, which includes making inquiries about changes. So, for the purpose of risk assessment procedures and related activities, right? Includes making inquiry about changes in circumstances that may give rise to new accounting estimate or the need to revise existing ones. Understanding of how management make the accounting estimate and data and assumptions on which they are based include the method, including where applicable the model used in making the accounting estimate. Relevant control. So I will just go through these things. So we have almost discussed most of the critical aspect at high level, at detail level. Whether management has used an expert. Now, when it comes to fair valuation of investment property or revaluation of property, plant, and equipment, generally they use a management expert, right? The data and assumption when it comes to actuarial valuation of defined benefit obligations, they use an expert, right? The data and assumption underlying the accounting estimate, whether there has been or ought to have been a change from the prior period in the methods for making the accounting estimate, and if so, why? And whether or if so, how management has assessed the effect of estimation answer. Then the review the outcome of accounting estimate, including the prior period of a period financial statement or as applicable, their subsequent re-estimation in the current period. Nature and extent of review takes account of the nature of the estimate and whether information to be obtained is likely relevant to identifying and assessing the risk. Not intended to revisit prior judgment, right? Basically, review of outcome of accounting estimate included in the 5 period. So as I explained earlier, but difference is basically it's not that not intended to revisit prior judgment of management or to challenge, but to see whether there was an error. But as I explained earlier, outcome of an accounting estimate, which is different to what was estimated at the time of making the accounting estimate, does not necessarily represent a mistake. Because when it comes to accounting estimate, you look into the future based on best available information at the time you make the accounting estimate. So some of the information which came to light subsequent to estimation would probably change the amount of the estimate, right? In identifying and assessing the risk, the auditor shall assess inherent risk and control risk separately. So as I explained, generally we consider combination of both inherent risk and control risk together. But under ISA 540, you need to assess inherent risk separately. In assessing the inherent risk, auditor should take following into account. Evaluate the degree of estimation uncertainty associated with an accounting estimate, basically as assessing the inherent risk factors. The degree to which the following are affected by complexity. Complexity is subjective to other inherent risk factors. Now, if you take the estimation uncertainty, complexity and subjectivity are inherent risk factors. Then you also have other inherent risk factors, certain changes to the financial reporting framework, management bias, right? The selection and application of the method, assumptions, and data. MAD, right? In making the accounting estimate, method, assumptions, and data. The selection of management point estimated and related disclosures for inclusion in the financial statement. The matters that the auditor considered in assessing the risk of material misstatement may also include the actual or expected magnitude of accounting estimate. That so this is basically explaining when you consider the assessing the risk of material misstatement, spectrum of inherent risk, magnitude of likelihood of misstatement occurring, and magnitude of potential misstatement. That's what is saying. Matters that the auditor consider in assessing the risk of material may also include the actual or expected magnitude of accounting estimate and likelihood of misstatement occur. The recorded amount of the accounting estimate, that is management point estimate, in relation to the amount accepted by the auditor to be recorded. Whether management has used an expert in making the accounting estimate. The outcome of the review of prior period accounting estimate. All these factors you considered as part of identifying and assessing the risk of material misstatement associated with accounting estimate. First, you understand the entity and its environment, including internal controls. So, what are the internal controls available to identify the need for a new accounting estimate, any changes to the existing accounting estimate, right? And then you consider the inherent risk factors, estimation uncertainty, complexity, and subjectivity associated with each accounting estimate, and including other inherent risk factors. Then you consider when you assess the inherent risk factors and in resulting in the either higher or lower inherent risk, the magnitude of potential misstatement and the likelihood of misstatement occurring. And then you also consider whether the management has used an expert in making the accounting estimate, the outcome of the prior period accounting estimate, whether they have resulted in, when you compare with the actuals against the previous accounting estimate management has made in the previous financial statement, whether you have seen significant deviations, whether that is result in management bias or due to certain inaccuracies. So all these things you consider when it comes to identifying and assessing the risk of material mistake, right?
Excuse me, Vajra sir.
Yes,
Hello.
yes, yes,
So
Nataraj.
extremely sorry for disturbing, sir. Could you
Yes.
please check the chat box, sir? I sent you a message.
Yes. Dear sir, sorry to disturb. Right, right. So
So
actually, I
actually,
wanted
someone
to.
regarding
I'm
has
actually. I
yes.
was about to stop Natasha and then to continue on next Wednesday. So I'll stop at
Okay,
this
sir.
point.
Okay, sir.
Sorry, actually, I didn't know because I cannot see these chat messages.
No worries, sir.
Basically, when I do the go through the
Yes, we
presentation.
initially planned the lecture until 5:30, sir. But unfortunately, we didn't know that they have another lecture. That's why, sir.
No problem. So that's why I wanted to stop. So I will immediately stop. So basically, we have
Oh,
done up to this point.
yeah.
Up to this point. So I'll start from this slide on Wednesday and we'll continue the other presentations. And depending on
Okay.
the time available, we can consider to have another day too if there is left something left over on the,
Yes.
next lecture, right? So thank you very
Okay,
much
sir.
for your time. If you have any
Thank you
questions,
very
so you
much.
can reach at the next lecture, right? Thank you.
Thank you very much, sir.
Okay, thank you.